3, 2, 1, go.
Good evening, everyone. Thank you for joining the webinar this evening and giving up your time. It's just after 6 o'clock, so we will make a start. My name's Gary Ford. I am BFREPA's policy advisor. A thank you, before I forget, to Kate and Keith for organising this evening's webinar. The aim is for the webinar to last 1 hour, and we are hoping that the session will be informative and help our members to understand what has changed in the recent budget and what they might do about it. When I was thinking about this subject after the budget, it occurred to me that there is uncertainty and confusion out there about what the changes are and what does this mean for my family farming business. And so whilst the purpose of this webinar is to raise awareness and not to go into detail, our strong advice to members is to seek professional advice for guidance and support. The aim of the webinar is to add clarity on what has changed, highlight using some case studies what the impact could be, and importantly, what members can do about it. As it currently stands, the rules on IHT come into force in April 2026, so there is time to plan. I'm delighted that we have secured the services of a top advisor in their field, and pardon the pun, Sean McCann from the NFU Mutual. I will introduce Sean more formally in a moment. As you will be aware, there has been and continues to be a lot of lobbying going on at Westminster and beyond, much of which BFREPA and its members have been involved in, which may result in changes. But I stress today's webinar is based on the facts as they apply today. The webinar will be recorded so that members can watch it again, and those members that are not able to join us can also watch it. We will hear shortly from Sean, who will run through his presentation, and at the end, he will take questions. Throughout Sean's presentation, please, which will take about half an hour, please think about your questions and post them in the Q&A function. Please note that the questions will be visible to everyone on this call and potentially on the recording. So you may want to consider posting them anonymously if they are at all financially sensitive. Before I introduce Sean, you may be aware that we have been running a survey for the past three or 4 weeks, and thank you to the members that completed the survey. In total, we had nearly 100 responses. The aim of the survey was to get a feel for members' awareness. Had they taken any professional advice, and what impacts the changes in the budget could have, so as to tie in with the themes of this evening's webinar. So before I introduce Sean more formally, we'll just spend a few moments to go through the 5 questions that were contained in the survey. And as I say, thank you again to the members. We're indebted to members that complete these surveys, because without members completing them, we wouldn't have a great deal of results to share. So 5 questions. The first question, not surprisingly, 100% of members that responded had heard about the inheritance tax changes announced in the recent budget. Next slide, please, Kate. The second question was, have you looked at the impact of these changes on your family farm? And 9 out of 10 respondents had looked at the impact of these changes on their family farm, which is encouraging, which is positive. Next question, please, Kate. And then we asked, a bit of a blunt way of putting it, but I couldn't think of a better way of positioning it. On a scale of 1 to 10, 1 being very little impact, to 10 being significant / severe financial impact on your family farm, what impact do you think the changes will have on your family farm? And the average score that was given to this question was, as you can see on the screen, 7 out of 10. So I've interpreted that as moderate to significant impact on our members' family farms. Question 4, please, Kate. The next question was around, have you taken any specialist advice on the impact of IHT before or since the budget changes? And 6 out of 10 of our members said they had taken some specialist advice. 4 out of 10 at the time of the survey hadn't. And then the final question, please, Kate. And then finally, again, it was a scale of 1 to 10. How confused are you by the inheritance tax changes announced? And the average score we had was 5.5 out of 10. So I would interpret that as some confusion out there amongst our membership. So thank you again for those members that completed the survey. I was keen just to capture those responses and to publish them ahead of this evening's webinar, just to give us a bit of a feel of what the situation is out there amongst some of our members at least. Now to this evening's presentation. I'm delighted to say, based on my knowledge and my own experience, we have secured one of the NFU Mutual's top experts in their field on the webinar this afternoon, Sean McCann. Sean is a chartered financial planner with 30 years experience advising farmers and business owners on inheritance tax and pension planning. Sean has a wealth of experience gained over all those years on maximising the available tax reliefs and avoiding the pitfalls. And Sean is widely regarded as an expert in his field, not just in agriculture, but further afield. And his articles have featured regularly in the national media, including the Times, Telegraph and Financial Times. Without any further ado, I'd like to pass over to Sean to run through his presentation. As I said at the start, this will take about half an hour. Please think about the questions as we go along. Post them in the Q&A function on the screen. Put them in there anonymously if they contain anything that might be slightly sensitive from a financial point of view. And at the end of Sean's presentation, I'll read out hopefully all of the questions. We'll see how time allows, but please post the questions and we'll do a Q&A session immediately after Sean's presentation. So thank you. Without any further ado, I'll pass over to you, please, Sean. Thank you.
Okay, thanks, Gary, and good evening, everyone. I've been looking at budgets for many, many years, since my time working with NFU Mutual. I don't think I can remember a budget where there was more speculation going into it about things that might change. And I think the reason for that speculation was that all we had to go on, really, was what was in the Labour Party's manifesto around tax. And what we knew from that was that we wouldn't see any increase in income tax rates or employees' national insurance or VAT. And that inevitably meant that we would see more taxes on capital. And that is exactly what we did see. Obviously, I'm sure you're all familiar with these big changes to inheritance tax from April 2026. Pensions, big changes there. Currently, as we sit here today, pensions, an unlimited amount of pension money can be left free of inheritance tax on your death. That's changing from April 2027, so we'll come on to talk about that. There were changes to capital gains tax as well, which is a tax you pay, I'm sure many of you are familiar with. It's a tax you pay when you sell something for more than you acquired it for, or you give things away. You could be hit for capital gains tax as well. And there was also the very, it wasn't unexpected news that employers' national insurance would increase. And this is probably the biggest revenue raiser for the government from all the changes that they announced. And it's going to have a wide-ranging impact. And it will obviously feed through to to employees' pay rises as well, because it's going to put a strain on businesses. So obviously the headline grabbing announcement was the changes to agricultural and business property relief. Now, what those reliefs are for, they've been with us for many, many years. Agricultural property relief, that's designed, when it was introduced, its aim was to protect family farms or farming businesses when they're handed down a generation. Because the theory being is that if you levy inheritance tax every time a farmer dies, basically that can mean the family have to sell land or buildings in order to pay the tax. And that leads to smaller, less efficient farming businesses. So that's why we have inheritance tax, agricultural property relief. And business property relief is designed in a similar way. What the government don't want to do is break up viable businesses when the owner dies. Because what that could mean is that the next generation who want to take over the business often need to go and borrow money in order to pay the tax. And that's money that isn't invested in the business to make it grow and produce jobs, etc. So before I go into the detail of the changes to those two reliefs, I think it's important just to go back and recap on what inheritance tax is and how it works. So in its most simple form, inheritance tax is a tax on what we leave behind when we die. Because when someone dies, the family need to make a return to HMRC, and they need to list all of the deceased's worldwide assets. When I say all, I do mean all. So I'm talking about cash, property, investments, wherever they are in the world, go on that return. Now, anything you leave to your spouse or civil partner is exempt without limit. So if I died with assets, business assets, investments, etc., worth, let's say, £10 million, and I left it all to my wife, she wouldn't pay a penny of inheritance tax on my death. Now, all of us on this call have a tax-free allowance we can leave on our death of £325,000. Now, if I leave everything to my wife, I don't use any of that allowance. So what it means is it can pass over to my wife. So when she dies, she can leave £650,000 tax-free. That's her own £325,000 allowance plus mine. Now, there's also an additional tax-free allowance that's available to some people. Now, the way this works is it's worth £175,000 per person, and it can be used against the value of your home when you die. Now, the reason I say it's available to some people is it's only available if you leave a share of your property to a direct descendant. So if I leave a share of my home on my death to my children, my grandchildren, stepchildren, adopted children or foster children, I can have £175,000 of it tax-free. If I didn't have any direct descendants, I didn't have any children of my own, if I wanted to leave my house to my niece or nephew or to my siblings, I wouldn't get this allowance. It's only available if you're leaving your home to a direct descendant. Now, it is transferable between spouses. So if I die and leave my share of my home to my wife, on her death, she can leave £175,000 of her own towards the value of the home, plus mine. So that's £350,000 of the value of our home can be left free of inheritance tax. Now, if you add that to the two lots of £325,000, adds up to £650,000. If you put those two figures together, you get £1 million that a couple could potentially leave free of inheritance tax on their death. Now, there is a little bit of sting in the tail with this particular one, the extra allowance on the house, is that if you leave an estate worth more than £2 million, you start to lose this allowance. So for every £2 you leave over 2 million, you lose £1 of the allowance. So let's say I left an estate worth 2.35 million, and that's before any agricultural or business property relief. I wouldn't get this allowance because it would be eroded away. So for every £2 over, you lose £1 in the allowance. So at 2.35 million, you don't get this allowance at all. Now, you'll be pleased to know that's the most complicated piece of legislation I'm going to explain to you this evening. But it's one to bear in mind. So what does that mean? How does that translate in terms of the inheritance tax bill? Well, if we take a single person, so someone who's not married on their death and they don't have any direct descendants, they'd get £325,000 tax-free on their death. So you can see if they left an estate worth £500,000, the family would need to find £70,000 to pay the tax. Because importantly with inheritance tax, in most cases, the inheritance tax must be paid first in order to get probate. And you need probate to be able to distribute the deceased's assets to the beneficiaries. And you can see on the screen, the bigger the estate, the deeper the tax bites. So a single person who leaves £1 million, assuming they have no direct descendants, the family would have to find £270,000. And again, you can see 2 million, it's more than a third of the estate. Okay, but for married couples who do have children, this is what the tax looks like. At £1 million, assuming they have a house worth at least 350, there is no inheritance tax. At 2 million, the family would need to find £400,000 to pay the tax. And again, at 3 million, the deeper the tax bites. So it's a big issue. And as I said, the inheritance tax has normally got to be paid within 6 months of death. There is an exception to that in that if inheritance tax is due on residential property or agricultural land and buildings, you can choose to pay the tax in 10 annual equal instalments. So as an example, if I was left my parents' family home, and there was £100,000 of inheritance tax due on it, instead of having to find the £100,000, I could pay £10,000 up front in order to release the asset, and then pay over the next 9 years another £10,000. The slight sting in the tail is that for houses, you've got to pay interest on the outstanding inheritance tax. So in that example, I'd pay £10,000 up front, but for the following year, I'd need to pay interest on the £90,000 I owe. And currently that's charged at 2.5% above base. And from April next year, it's rising to 4% over base. Now, what the government have said is that any inheritance tax due on agricultural land and buildings, you can pay in 10 annual equal instalments and there will be no interest on it. So that was something they introduced fairly recently. Okay, so let's talk about agricultural and business property relief. Now, broadly, agricultural property relief is available at one of two rates if you manage to get it, if you qualify for it. So if you own and farm your own farm, and you've owned and farmed it for at least 2 years, and you're still farming it when you die, you would normally expect to get 100% agricultural property relief on the agricultural value of the lands and buildings. So what that would mean, as we sit here today, that would be free of inheritance tax. And it's unlimited. So if I left a farm that I'd owned and farmed myself for at least 2 years that was worth £10 million, the agricultural value was £10 million, I could get 100% relief. And what that would mean is the children currently would pay no inheritance tax on the value of those land and buildings. Now, even if I'm not farming, if I own agricultural land and buildings and I rent them out to a farmer, as long as I've owned it for at least 7 years, and throughout that period, it's been occupied for the purposes of agriculture, and I either have the right to vacant possession within 24 months, or the tenancy I've granted was granted since the 1st of September 1995, again, I can get 100% agricultural property relief on the agricultural value. If I've got land that I perhaps let out on an old Agricultural Holdings Act tenancy, I'll be restricted to 50% agricultural property relief on the value. And what that means is that half the value would be free of inheritance tax, and the other half would be subject to, included in my estate, and potentially subject to inheritance tax. So it's this relief that's led to a lot of inflation in farmland prices. Because if you think about it, if I were a very wealthy individual with a huge inheritance tax problem, why don't I go and buy some farmland? And what I could do, I could put a farm manager in there and let him or her run it for me, and I'll suffer the profits and losses. And after 2 years, I would get 100% agricultural property relief on the agricultural value. And what that means is that would be free of inheritance tax, currently unlimited. Now, if I didn't want to suffer the profits and losses, what I could do is buy some agricultural land, rent it out on a farm business tenancy, let the tenant pay me a rent, and after 7 years, it would be exempt from inheritance tax without limit. What's also important to farmers as well is business property relief, because I mentioned business property relief is designed to protect trading businesses when they're handed on down to the next generation. So a working farm, as an example, would normally claim agricultural property relief on the land and buildings, and business property relief on the machinery, the stock, etc., the crops, etc. All that will be subject to business property relief in most circumstances. So business property relief is available to trading businesses, not investment businesses. So just let me give an example of what I mean there. So let's say I ran a garage business and I own the physical building and I own all the machinery and the kit in that garage. I've run it for at least 2 years and I died. I would normally get 100% business property relief on it. So what that means is the value of the building and all the kit and the machinery would be exempt from inheritance tax. But just to contrast that, let's say instead of that garage business, I own 10 buy-to-let properties and I spend all my time out there picking up rents, negotiating tenancies, maintaining the properties. I might view those properties as my business and my full-time job. And it is a business, but the revenue would deem it to be an investment business that produces passive rental income. And that's deemed to be an investment business that doesn't qualify for any relief. So in that example, all 10 of those buy-to-let properties would be in my state for inheritance tax. Now, where we see this impacting farmers is that many farms have diversified for reasons that we're all familiar with. But let's say on my farm, I've converted a building to workshops, let's say, and I've rented them out to some local tradespeople. I've got a furnished holiday let going on as well, and I do a little bit of caravan storage. I rent, I allow people to store their caravan over the winter and pay me a rent for it. I've also rented out some land for some solar panels, and I'm picking up rental income from that. All those activities are investment activities. Now, in the first instance, they look like they won't qualify for any business property relief, and that's true in a lot of cases. But there are ways, which you'll be pleased to know I won't bore you with tonight, there are ways of organising that potentially to get business property relief on those assets as well. But again, that's something that our advisors are available to talk about if you want more detail on that. So what's changed? Well, the budget, the budget announcement It wasn't entirely unexpected, because we did think there was potential for a cap to be introduced, but we were a little bit surprised the cap was set as low as was announced. So basically what it means is that from April 2026, the combined value of agricultural and business property relief at 100% will be limited to £1 million. But it's important to say that is per person, not per farm. And I'll come on to explain why that's important in a moment. So today, as I've explained, if I own my own farm, I run it myself, I should get 100% agricultural business property relief without any limit on it. But from April 26, this is going to be capped at £1 million, the first million. After that, any value in excess of that will only attract 50% relief. And what that means is that half of that excess value is tax-free, assuming it qualifies, but the remaining 50% is subject to inheritance tax. And it's really important to say at this stage as well, when I talked about those other reliefs earlier on, so that 325,000 we can all have tax-free, and the 175,000 that you can use against the value of your home if you leave it to a direct descendant. If I don't use that on my death, I pass everything to my wife. She can use those two allowances. But the way the rules have been introduced here, it's saying if I don't use that £1 million allowance on my death, so I pass all my farming and business assets to my wife, she can only use her own £1 million allowance. She can't use mine. It cannot be transferred between spouses. So that's an important thing to bear in mind. But let's show you some examples here of what this practically means. So this is John. John's a widower, lost his wife several years ago. He's got 200 acres, which is broadly valued at £2 million. He's got a poultry unit worth £1 million, and he's got farmhouse and buildings worth another £1 million. So his total agricultural assets are worth £4 million. If he had died today, then basically he would normally attract 100% relief on that, and there would be no inheritance tax. Now, if John dies after April 2026, the first £1 million will attract 100% relief, so that will be tax-free. The remaining million attracts 50% relief. So what that means is half of that 3 million is tax-free, but the other half, 1.5 million, is subject to inheritance tax. Now, John's wife left everything to him on her death, so he can go back and use her 325,000 tax-free allowance plus his own. But because he's left assets worth more than 2.35 million, he doesn't get that extra allowance on his house. That's gone, it's lost. So what this means is, of the 1.5 million that's taxable, only 2 lots of 325 are tax-free. That's 650 tax-free. And what's left is taxed at 40%. And 40% of that figure is £340,000. So whereas if John died before that date, there would be no tax, the way the rules have been set up or announced is that his family would face a £340,000 inheritance tax bill on his death. Now, let's just look at a second example. Bigger farm, a diversified farm business owned by Tom and Kate, a married couple. It's worth about £6 million. So what happens under the new rules? Again, as we stand today, the farm would probably be exempt from inheritance tax. But when the new rules come into being, let's assume Tom dies first. What he could do is pass £1 million of assets, of the farming assets, direct to his children. And that would attract 100% relief, agricultural business property relief. So that's free of inheritance tax. The balance passes to his wife, Kate. So she's got £5 million worth of assets. On her death, she's entitled to £1 million of agricultural and business property relief as well. So what they've done between them is pass on 2 lots of £1 million. And that's really important, because if either one of them owned everything in their name, they would only be using £1 million allowance. So moving assets between spouses is likely to become more common in the planning for these rules, to make sure you use both sets of £1 million. But coming back to this, so Tom has died, Kate's got £5 million worth of assets. She dies, leaves £1 million tax-free. So the children have had £2 million tax-free, but there's £4 million left on Kate's death. That will attract 50% relief. So half of the £4 million is tax-free, but the other half is subject to inheritance tax. That's obviously £2 million. There's 2 lots of 325, 650 available, but that leaves 1.35 million taxable at 40%. So that's a tax bill on the second death, on Kate's death, of £540,000, whereas today that wouldn't exist. Okay, so what are some of the things you can do about this? Now, obviously, I'll just mention this, it may be applicable to some people, it's one just to think about. Let's say today I've already got an inheritance tax problem, and a loved one dies and leaves me £100,000. That could be £100,000 in cash, it could be £100,000 of farmland, it could be anything, basically. Now, if I accept that inheritance and I give it away, I need to live 7 years. If I don't live 7 years, that gift that I've made is counted back into my estate. So what that means is it would be potentially subject to inheritance tax. Now, if I did receive an inheritance today, one thing I could do, instead of taking that inheritance, let's say it's cash just for ease, instead of taking that £100,000 and giving it away, what I could do within 2 years of my loved one's death is divert that inheritance straight to my children. And if I die in that 7 years after doing that, it's as though I've never touched it. So it's not included back into my estate. So if you've inherited assets or cash or investments or whatever in the last 2 years, it's one to think about. Now, my children currently are 21 and 19. I'd be a little bit wary about giving them £100,000 today. So what I would do a deed of variation and divert that into a trust that my wife and myself would be trustees of, and will decide when the children get the cash or the assets. So it's a way of doing it without necessarily giving direct control to the children now. Now, another way of doing this, what we think we'll see more of, is some people basically insuring their liability, because some people will choose not necessarily to gift any assets away, business assets away. One option open to people is to take out a life insurance policy in trust that pays out on their death, that gives the next generation a tax-free lump sum of money to help pay an inheritance tax that's due. Now, the sort of policy we normally recommend for this is what we call a whole of life insurance. And it's called a whole of life because it will pay out one day. Whether you die at 85 or 105, we know we're paying it out. And what we do is write it in trust. So on your death, when we see a death certificate, we don't have to wait for probate. We can pay the money out to the trust, and the trustees can pay that to the family, who then use the money to help pay any tax that's due. Now, to give you an idea of what that costs, this is showing you what £100,000 worth of whole of life cover would cost. Obviously, the older you are, the more expensive this is. These rates that you can see on the screen are based on someone who doesn't smoke, and they're accepted at standard rates. So someone who does smoke, it does cost more money because obviously you're more of a risk, and sort of certain health conditions can make it more expensive as well. But that just gives you an indicative cost, and you can see, at 70, it costs you just under £300 a month on standard terms. So again, that's something that our financial advisors can talk about in more detail if needed. Now, the other thing, again, what we think we'll see more of is also people giving away business assets during their lifetime. Now, if you're giving assets away, in the budget, the government said, if you give agricultural business assets away any point from budget day, and you die within 7 years after the 5th of April 2026, then they'll be caught under the new rules. Now, if you're giving things away, the other thing you need to be conscious of is what we call gifts with reservation. The way this works is that if you make a gift of something, but you reserve a benefit for yourself, the revenue deem you've never given it away for inheritance tax purposes. So I'll give you an example of what I mean. Probably the most common question I'm asked is, can I give my house to my children and live there rent-free to be free of inheritance tax in 7 years? Now, I say, apart from being a terrible idea, in my opinion, okay, the answer to that question is no. If you want to give a property to your children and you want to live there, you need to pay them a market rent to do that. So you need to get 3 local estate agents around. What would you rent this for? What would you rent this property out for in the open market? Take the average and pay that to your children, and revisit it regularly as well to make sure it's keeping pace with market rates. So what it does mean is that also what we're looking at, and the whole sort of advice industry is looking at the moment, what does that mean for business assets? So if me and my wife own all the business assets now, and we pass some of them down to the children during our lifetime, what does it mean if we're still making a living from them? And again, there will be ways of structuring this. And as Gary said right at the beginning, we have got a breathing space in order to plan this as well. So more information will be coming through on that over time. But what we think we'll see as well is people ensuring that 7-year period, because assuming you make the gift and there is no gift with reservation, if you live 7 years, it's free of inheritance tax. But if you die within 7 years, it's counted in your estate. So what we normally do for people in these circumstances is we insure them for 7 years. And if they die within that 7-year period, the policy pays out. If they don't die, there's no money back at the end. Now, both the customer and us hope we don't have to pay this money out. Okay, this is why it's a lot cheaper than whole of life policy that we know we will have to pay out. And again, so a 40-year-old insuring their life for 7 years for £100,000, it's less than £7 a month. You can see the figures on the screen, which I won't bore you with, but it's just ensuring that period, so protecting the business in case something happens in that 7 years after you gift business assets. Okay, just to talk to you as well about capital gains tax, because if you are considering giving assets away during your lifetime, business assets or any other assets, it's important to be aware of capital gains tax, because most people are familiar with capital gains tax in that they sell an asset for more than they acquired it for. They often, most people are aware they will pay capital gains tax. But capital gains tax can also be paid on gifts. So as an example, we've recently had a case with a customer who had a buy-to-let property which they decided to give to their children. So they bought the buy-to-let property for £100,000 10 years ago. It's now worth £220,000. So they gave it to their children as part of an inheritance tax exercise. But because there was £120,000 worth of gain, so it's worth £220 today, they only paid £100 for it, £120,000 worth of gain in there. They didn't realise that they paid capital gains tax on a gift. So they got a capital gains tax bill, even though they hadn't received any money to pay for it. So it's one to be aware of. So before you give assets away or investments, it's important to take advice just to work out what that bill would be on that gift. And it's important to say as well with capital gains tax is it's washed away on death. So the advice up till now has always been pretty much, if you own a farm or a business, trading business, keep within the business, be seen to be running the business. That way, if you die, you should get 100% agricultural business property relief. And then any gain that you've built up is washed away on your death. So you could have a scenario where someone had bought a farm for £1 million. Today it's worth £5 million. They die, they would get 100% agricultural property relief on the 5 million today. And then the children could sell it the day after their death and pay no capital gains tax. So that was why that advice was sensible. But obviously in the new world from April 2026, because of the cap on agricultural and business property relief, that isn't necessarily going to be the right thing to do. Okay, now the good news is if you're passing on trading assets or assets that qualify for agricultural property relief, so that could be let farmland that you don't farm yourself, but any trading assets, if you pass them on to the next generation, or even if you pass them into most types of trust, you can get a relief called holdover relief. And just let me give you an example of the way this works. What it's designed to do is to encourage business owners, farmers, etc., to pass on assets without hitting them with a capital gains tax bill. I'll just show you an example of how it works. So this is Chris. Chris bought a business for £1 million in 2010. Today it's worth 2 million, and he wants to gift it to his daughter Kate so she can carry on with the business. If they both claim holdover relief, there will be no capital gains tax at the point that Chris gifts it to his daughter Kate. No capital gains tax for Chris to pay. Now let's say Kate keeps it going for another 2 years. She does very well with it, and now it's worth 3 million. Kate gets an offer to sell it, and she decides to sell it. Now the gain there would be its current value, 3 million, less what her dad had paid for it, the million. So Chris's gain isn't washed away, it's just deferred until Kate gets rid of the business. Now, if Kate is sensible, she could take that £3 million and reinvest it into another trading business and claim what's called rollover relief. So that would defer the gain as well. So there'd be no tax at that point. But if Kate takes the money and goes away and enjoys it and doesn't reinvest it, then she would pay capital gains tax on that £2 million worth of gain. Okay, the other unpleasant news in the budget as well was the news that from April 2027, anything left in your pension would also be included in your estate for inheritance tax. Now, as with any other assets you leave to your spouse or civil partner, that's exempt without limit. So if I had £2 million in my pension fund on my death, I could leave it all to my wife and she wouldn't pay a penny of inheritance tax on my pension fund. But if I leave my pension fund to my children, grandchildren, anybody else, it will be included in my estate for inheritance tax. Now, this isn't changing until April 2027. So I'll just mention why pensions are still very, very attractive, because what pensions are for, basically, the government encourage us to invest in them so that the way they do this is that for every £80 we pay in, they put another £20 in on top, even if you're a non-taxpayer. If you pay only 40% tax, what you could potentially do, you pay 80 in, government puts in 20, you create a pot of 100, you can then claim up to another £20 back via your tax return. So in effect, you could potentially get a pot of £100 at a cost to you of £60. And if you're paying 45% income tax, you can claim £25 back off your tax return. So you create a pot of £100 at a cost you of 55. That's the incentive, the way the government encourages us to keep paying money into pension. Now, obviously, the way the pension rules work at the moment is that if you die before you're 75, there is no income tax for your beneficiaries to pay on the money they take out of your pension fund after your death. But if you die after 75, the family need to pay income tax on the money they take out. And that could be from an already taxed fund. So the fund could have been subject to inheritance tax, and then the family will have to pay additional income tax to take the money out. So I'll give you an example of what I mean. I leave, let's say, £100,000 in my pension fund on my death, and I die at age 85. It's £100,000 left. I've got an inheritance tax problem already, so my family will pay 40% inheritance tax on that £100,000. That takes it down to 60,000. Because I've died after 75, to take that £60,000 out, my family will need to pay income tax on it. Now, what they're sensible, what they'll do, if they're basic rate taxpayers, take it out and they could potentially only pay 20. They'll stagger the withdrawals from it and potentially only pay 20%. But in all likelihood, if they're higher rate taxpayers, they're going to pay 40% of it. So 40% of 60,000 is 24,000. So that's 24,000 off the 60. That leaves £36,000 left of the original 100. So this is quite a big change, and we're hoping that the government are going to revisit this. Okay, but that's the way the rules will work following the announcement. So what should people be doing with their pension? Well, obviously these rules don't come into April 2027. So people who are sort of intending to leave money in their pension funds, to be free of inheritance tax, they've still got that protection until April 2027. So we'd say if you don't need the money, don't touch it. But once we get to that date of April 2027, it definitely makes sense to take your tax-free cash, because if you put it in the bank or building society or invest it elsewhere, it's only going to suffer potentially inheritance tax, but it won't suffer any more income tax on your death. Or there are other inheritance tax mitigation products, which I won't bore you with this evening, you can invest in, or you can give it away and hope you live 7 years. And the other thing you can do is, when you get to that age, is take the income, and even if you don't need it, there's a very generous relief from inheritance tax called gifts out of normal expenditure. And the way that works is if you've got income, so if you make gifts out of your income that are regular, so it could be every month, every quarter, or every year, they're from your income and not out of capital, and they don't impact on your normal standard of living, you can give away an unlimited amount of excess income. So I'll give you an example of what I mean. Let's say I've got an after-tax income of, say, £5,000 a month. And to live my life and look after my family and pay my bills, it costs me £3,000 a month. So in theory, I could give away up to £2,000 every month, completely exempt from inheritance tax. I might do it at the end of the year and pay my children, £12,000 each, if I chose to. But it's really important to keep records of your income, records of your expenditure, and records of your gifts, and also your intention to make that a regular gift. But what a lot of our older customers will do, and currently do, is they use that exemption. Many people, as they get older, don't spend all of their income, so they do have spare income. They often use that to fund a whole of life insurance policy, or just to give the money away. Or if they don't want to give it direct to family, put it into an investment in trust that, for the family's benefit, and that gets it out of inheritance tax. And just while we're on the subject of capital gains tax as well, any disposals, the rates that we pay from budget day, the gain is added to your other taxable income. If it falls in the basic rate, so the basic rate of income tax is only income up to 50,270. If anything's in the basic rate, you used to pay 10%, but from budget day you pay 18%. Anything over and above that, you used to pay 20, and now you pay 24. And what that's doing is just bringing it into line with the rates of capital gains tax on disposals of residential property, such as buy-to-let. This also changed the budget. Business asset disposal relief. This is for people who are normally disposing of a business completely, perhaps because they're retiring. They don't have to retire, but it's if you're disposing of a whole business, it could be giving it away or selling it or whatever. Those of you with really good memories might remember when this was called Entrepreneurs Relief, and it used to apply to £10 million worth of lifetime disposals. But basically, it was brought down to £1 million a number of years ago. And what it means is the first £1 million of gains, if you're selling your business, are only charged 10% capital gains tax, rather than 24 potentially. But from April 2025, next April, then that is going to pay 14% on the first million, and from 26, 18%. So we think we'll see more people, if they were planning on retiring anyway or selling their business, we think that we'll see them perhaps bring that forward. And the other thing as well, I'm sure many of you that employ people are more than aware of this, the increase in employers' national insurance. It's had quite a lot of headlines. It's the biggest revenue raiser of all the budget announcements. Currently, if you've got an employee and you pay them more than £9,100 a year, you pay 13.8% on any excess that you pay them in the employer's national insurance. And you have an employment allowance. So what that means is if the previous year your total national insurance bill was under 100,000, you get £5,000 off your employer's national insurance bill. What's happening from April next year is that not only is the rate going up from 13.8 to 15%, but you'll pay it on any earnings you pay your employee over £5,000. So it's a lower threshold and a higher rate of tax. But the employment allowance will be available to all employers. So the first 10,500 of employers' national insurance bill will be exempt. But it will have a big impact on many employers. What it does do as well, those of you that run your businesses as limited companies, is does make a decision, reconsidering the decision of how to take profits out of your business. Because if you own and run your own company, you've normally got three ways of taking your profit out of the business. You can pay yourself a bonus or increased salary. If you're a shareholder, obviously you can take it out via dividends, or you can take it out via, as a director, you're an employee of the business, potentially the company can pay it to you via an employer's pension contribution. So I'll just show you some examples of this. This is Beth. She's a company director. She's paying herself a reasonable salary. She's just into the high rate of 40% tax. She's paying herself £55,000. Her company has made a profit of £100,000 and she wants to take £40,000 out. So how should she do it? Well, from next April, if we look at salary, if she takes it out as salary or a one-off bonus, the company, her employer's got to pay 15% employer's national insurance on what they pay her. So of the 40, some of that's got to go to pay the employer's national insurance. So that means a gross bonus before tax for Beth of just under 35,000. That's the 34,783 figure you see. Beth is then going to pay 2% national insurance as an employee. That's the 696 figure. And then she's got to pay 40% tax on it. So what Beth is left with, what hits her bank account, is just over 20. So she's paid almost 50% tax and national insurance to get that money out. Now, as an alternative, she could take it out as a dividend. Now, before the company declares a dividend, they've got to pay corporation tax. And that's the £10,600 figure you see there. So that leaves just over 29 to distribute as a dividend. Now, we can all have £500 worth of tax-free dividends every year. Even taking that into account, Beth will still pay just under £10,000 in income tax on that dividend. So that leaves her with just under 20 of the original 40. So she's actually paid almost 51% in tax to get that money out. Now, as she's an employee of her own company, the company could take that £40,000 and pay it into a pension for her as an employer's pension contribution. Now, the good thing about that is there's no corporation tax on it, because that is an expense of running the business. So it comes off profit before the company is assessed for corporation tax. Also, the employer doesn't pay a penny of employers' national insurance on money they put into their employees' pensions. And also importantly, Beth in this example doesn't pay any employee national insurance on it either. So what does that look like? Well, you can't get your hands on your pension money until you're at least 55, and that's going up to 57 from 2028. But Beth is in her mid-50s. Let's say she turns around and decides to take the money out of that pension. If she's still a higher rate taxpayer, she'll get 25% tax-free as a lump sum, and that's the £10,000 figure that you see. But if she wants to take the rest out as a lump sum, she's going to have to pay 40% tax on it, and that's the £12,000 figure you see. But that still leaves her with 28,000 of the original 40. Now, if Beth is well advised, what she should do is leave that money in the pension fund until she decides to actually, reduce her hours at work or potentially retire completely. And she's a basic rate taxpayer in retirement. So that £40,000, assuming there's no growth on it, she can still take £10,000 a lump sum. That's a quarter of the fund. But then she only pays 20% on what's left. And that's the £6,000 figure you see there. So she's actually left with 34,000 of the original 40,000 she started with. So she's only paid 15% tax. Now, if any of you are like me, I'm 56 years old. Good thing about pension, I put money into pension regularly every year. I mop it up to make sure I do the most I can, because I'm not that far away from wanting to take it, basically. And if I wanted, I could take it tomorrow. Obviously, it's a different consideration for younger people. I mean, the thing with pensions as well is that a lot of our farming customers say, particularly younger farming customers say, I hear what you say about pensions, and they're very tax efficient, but I'm saving up to buy land. And what we normally say to them is, well, build up your money in a pension fund, and when you get to a certain point, certain level, you can transfer it into a self-invested pension, and you can instruct the trustees to buy farmland if you want to. So you're holding farmland within your pension fund, or it could be commercial property. You're holding that in your pension fund, and then you then occupy it and pay a commercial rent to your own pension fund. But again, I won't bore you anymore with that this evening. So I'll just finish on a final slide really before we come on to questions, and just put in the sort of budget changes into some sort of perspective, because what the current government has done and the previous governments have done is freeze a lot of the tax-free allowances we're entitled to. So if we take the personal allowance, that's the amount of tax-free income each of us can have as long as our income is below £100,000. We can have the first £12,570 free of income tax. And the 40% threshold doesn't kick in until our income exceeds 50 to 70. That loss of personal allowance, that's the point at which for every £2 over you earn over that, you lose £1 of your tax-free personal allowance. So when you get to 125,140, your tax-free personal allowance goes completely. And the 325,000 inheritance tax free allowance, that hasn't moved since 2009. That was the last time it was updated, and it's due not to change until 2030. And that extra allowance we can have, most of us can have against the value of our home, 175, that hasn't moved for a number of years either. And just to give you an idea, if all these had been upgraded by inflation as they traditionally were, that's what they'd be worth. So you wouldn't be paying any income tax at all until you got to just over 15,000. You wouldn't be paying any 40% tax until you were earning just over 60. And inheritance tax, you can see there, you you think how much property prices have gone up, investment asset values have gone up over the years. That would now be worth £500,000, and the extra lamps on the house would now be worth almost 215,000. So it's indicative, it's fiscal drag. The government are they're not increasing the headline rates of income tax or inheritance tax, but they are getting in more and more revenue as a result of these, and more people are being affected over time. Okay, just before we come on to questions, just a quick compliance slide I need to put up, just to obviously make sure I've talked about a few things, talked about investments and pensions this evening. That second bullet point, obviously investments might go up and down. I'm sure you're all aware of that. I'm talking to you about the current tax law as it is today. Obviously that changed, and really before you do anything, as I said, we do have a breathing space around the inheritance tax changes. Take some advice based on your own circumstances. And on that note, Gary, if I hand back to you for any questions, I'll just stop sharing my screen.
Excellent. Thank you very much, Sean. That was extremely thorough, covering those changes from the budget. Plenty to think about, and this is exactly why we are strongly recommending to our members that they take professional advice in this area. Just on that, those of our members that have got a relationship with the NFU Mutual, typically through insurance, can they go contact their local office? Because you're national, they can't go to you because you're a busy person. Can they go to their local NFU Mutual office and get the same advice, guidance that you've just run through on the presentation, please?
Yeah, of course. Yeah. So we've got, as you're probably aware, 280 agents' offices across the UK, completely UK wide. I'm sure you're all familiar with the local NFU Mutual agent. Also, many of them double up as NFU group secretaries as well, as I'm sure you're aware. In those offices, each of those offices, we've got a financial advisor available. Who's part of my job is to make sure those guys are upskilled and on the latest changes to this. So yeah, they'll all be aware. So talking to your local NFU Mutual agent can put you in touch with one of our financial advisors. Obviously, our financial advisors, they deal with farmers, business owners day in, day out. This is what they do.
Yeah. Thank you, Sean. Just on the pension subject, I'm a big fan of pensions, and I've done similar to what you've done. I've put any spare money into my pension, but I feel betrayed now. What do you say to those people that say, look, I'm not going to put money into pension, I'll invest it in the business or do something else with that spare cash because of the changes? Any comment on that, please, Sean?
Yeah, I think pensions are still very, very attractive. I mean, the government are trying to incentivise people. The government incentivise people normally by giving them tax breaks. If there's things they don't want us to do, they use tax. So if you smoke or you drink, the taxes are fairly heavy on that because they're trying to discourage us from doing that. With pensions, they're trying to encourage us to save for our retirement, because what the government don't want is lots of pensioners in poverty. They then have to rely on the state to support them. So they give that incentive with pensions. So it is that thing, if you're paying 40% income tax while you're working, or 45% or whatever, when you put money into a pension, it's treated like that's money that's not taxed. So as an example, if I was a higher rate taxpayer, I put £80 in, government puts 20 on top, I fill in my tax return, I note that on there. And if you haven't been noting it on there, you can go back 4 years and do this as well, just if you're not aware of that. And then, so that's cost, I can claim another £20 back. So it's cost me £60 to get £100 in my pension pot. And then when I come to retirement, I can take a quarter of that tax free. And then if I'm a basic rate taxpayer in retirement, or I can make myself a basic rate taxpayer, I can only pay 20% on that money. So pensions are still very attractive. And I think I've mentioned this during the presentation. Obviously, I completely get a lot of our young farmers don't want to invest in pension because they want that cash accessible. but you can't touch your pension till you're at least 55. So, but we are encouraging them to say, well, build it up in the pension and get that tax break from the government. You can then use that via a self-invested pension to buy farmland if you want to. I'm not a huge fan of that, and the reason being is that having a diversified sort of investment is something that's not reliant on the success of farms or farming or land prices or anything. So, you can spread your money over all sorts of different investments, which I won't bore you with, but it's not subject to the vagrancies of farming. So if farming's not doing great, at the time I come to retire, my pension fund is not impacted. It's a great way. It's an independent source of income that allows the older generation to step away and perhaps take less from the business, because the business could be, you're all familiar with this, could be supporting 3 generations in a lot of cases. And having a pension means you've got your own independent source of income.
Yeah. Thank you. Going to the questions that have been posted, and thank you for members on the call for posting those questions. Continuing the pension theme, should I take as much tax-free money out of my pension now?
Personally, I would hold on till April 2027, unless you've got other plans for it, obviously. But as a general principle, money in your pension, God forbid if anything was to happen to you, if you were to die before April 2027, can currently be left free of inheritance tax. So you've still got that protection until April 2027. But as we get closer to that date, then it's important to take some advice, because there are lots of ways of, lots of options when it comes to taking money out. But yeah, unless you've got plans, unless you want to take the money now, if your plan is to make it inheritance tax efficient, I would suggest you leave it in there until April 2027. And then as we get closer to that date, and then assess your options again.
Okay. Thank you. Thank you, Sean. Another question on pensions. If agricultural land is held within your pension, would it still receive the 50% IHT relief if left to children? Or is it treated as if there were stocks in it and 40% is due within 6 months?
Yeah, it's a good question. We are looking for clarity on this from the revenue. Obviously the situation before April 2026, we know for sure is, from before April 2027, we know before April 2027, that any assets in the pension fund are free of inheritance tax. But post that date, the likelihood is that will be treated as a pension asset. So it's probably unlikely relief will be available, but we are looking for clarity on that from the revenue. Because before this change, before the announcement, it didn't really matter, because the pension was free of IHT and the land was normally free of IHT. But obviously that brings into focus the change that our expectation is it will be treated as a pension asset with no relief available.
Okay.
But we will get clarity on that, and obviously we'll push that news out through. We have a good relationship with farming publications. If things change, we send information out to them to publish, hopefully, and also via our agents and financial advisors as well. So we'll keep you posted.
Thank you, Sean. Has the NFU Mutual got a view on if this will impact the value of land? These changes announced in the recent budget that you've run through.
Yeah, I don't know, it's NFU Mutual's view. I can give you my personal view. And that is that, obviously, if you look at it, still, even post the changes, post April 2026, you still get the first £1 million free of inheritance tax. So if I'm a rich individual with no connection to farming, I could still buy £1 million worth of farmland, and it would be free of rented out to someone own it for 7 years, receive the rent. After 7 years, the first £1 million is free of inheritance tax. And if I own more than £1 million, let's say I own £2 million, even the £1 million, the excess, half of it is tax free and the other half is taxable. So there would only, in effect, be 20% tax on that excess. And there aren't too many investments out there that give you that sort of inheritance tax break. So personally, I'm not convinced that we're going to see a huge drop in farmland prices. But, my opinion is probably, you guys probably are more familiar with it than me. But yeah, I'm sure if we went around this room, Gary, or this virtual room, we'd have lots of different opinions. But that's my initial thoughts on it.
Okay. Thank you, Sean. Changing tack slightly, is the £175,000 available if the farmhouse is part of the farm business?
Yes, potentially, because it's also doubling up as your home as well. So yeah, if it's, the way, the sort of disadvantage for many farmers and business owners, where the house is integral to the farm, is that often the farm itself is worth more than £2 million, and you have this, as you know, you start to lose the £175,000 allowance. It's the value of all your assets before any agricultural or business property relief is applied. So we all know, it doesn't take too much farmland to turn it into an estate worth more than £2 million. But suffice to say, that would normally be available. We'd expect that. And that's part of the things the government have been saying, is that where they've talked about £3 million being free of inheritance tax, the way they're getting to that figure is on the assumption that everyone has 325, which they do. If you've got a couple, 2 lots of 325 is 650. 2 lots of 175 is 350. That's your first million. Then they're saying a married couple each own £1 million of the farming assets. They can each leave £1 million tax. That's how they're getting to 3 million. But we know that that isn't the situation everywhere. I think I used the widowers example. That's someone who was married, but their spouse has predeceased them. They've only got £1 million they can leave. But in terms of the farming assets, they might have 2 lots of 325. So that would only be 2 million. So that's not the 3 million the government's talking about. So that sort of generalisation does mask quite a lot of other situations where it's just not the case.
Okay. Thank you, Sean. Continuing the theme about the dwelling, and this may be beyond your area of expertise, but I'll ask the question, and you can perhaps comment if you've heard this before being raised. The question is, does the fact you can only leave the full value of your property to your children if you're married, but not if you're single or already widowed, contravene the Equalities Act?
Yeah, I can't comment on the Equalities Act, but if you're single and you have children, so let's say you've never been married, okay, but you have children, if you leave a share of your house to your children, grandchildren, direct descendants, you can still get that 175. So if you're single and you have children, you can get that allowance, with all things, you're not over more than 2 million, etc., etc. And even if you've been widowed a number of years ago before these rules came in, so we've dealt with a case where someone who had been widowed, their spouse died in the late 90s before these rules were introduced, but we were still able to go back and get that their late spouse, what their late spouse would have been entitled to. I think, when this was going through Parliament, there was quite a lot of, as you'd expect, and quite rightly, in my opinion, that there was quite a lot of, what about the people without direct descendants? Why shouldn't they get this allowance? Because, the easiest thing to do would have been to say, just give everyone £500,000 tax free. So if I didn't have children, I wanted to leave it to my niece or nephew, shouldn't I be allowed to leave it to them? So that's just my opinion. But yeah, it's not, it could be made more fairer, I think is the easiest thing to say.
Yeah. Okay. Thank you. A couple more questions, and then we'll look to close the webinar. Regarding the house gift with reservation, where is the money for the market rent coming from for the retiring farmer? If the farm pays them, they pay NI, etc., on the salary, in inverted commas, in order for the retiring farmer to pay his children the rent, which will then be counted as a profit and income tax levied. It sounds a bit, between a rock and a hard place. Any comment on that question?
Well, I mean, let's just look at myself as a situation. I'm an employee of NFU Mutual. So if I wanted to give I wouldn't do this, by the way, but if I did do it, I give my house to my children. I want it to be effective for inheritance tax. I obviously need to live 7 years, but I need to pay them a market rent. So that market rent has got to come from me to my children. So, and my children, assuming they're working, they're going to have to pay income tax on the rent that I pay them because it's their own income. And if I need to downsize in the future and the property needs to be sold, then there would be they would pay capital gains tax on any rise in the value between the date of me gifting it to them and the date of the sale. And also, what if my children divorce or go bankrupt? The house I've given them is their asset. So it could be attacked potentially as part of any divorce settlement. So, as with all these things, it's really important to go into to get your options, to work with an advisor, get your options laid out and the pros and cons of each, and weigh those options up before you do anything. Because, there will be a lot of advice out there, because I think, the paint is still drying on some of this stuff. As I think you mentioned right at the start, Gary, there's a lot of lobbying going on with the hope that this, can be reviewed in some way. So we'll just have to wait and see how this situation develops. But it's important, obviously, to stay on top of it. I think webinars like this are particularly valuable because it's quite a good and easy way of keeping certainly your members up to date. Whether we decide to run another one in 6 months just to update where we are. Because I think, it is potentially a moving situation.
Yeah. Well, thank you, Sean. Thanks for the offer to come back in 6 months or so time. You beat me to that particular comment or question. I've got 3 questions left, and then we'll look to close the call. One of our members, who is a political watcher, has posted a question to say that Steve Reed, the DEFRA Secretary of State, in questions today, still claimed that 75% of farms aren't affected. Presume this is because he is still ignoring the effects of BPR removal. Any comment on that?
Not really. Yeah, I know the NFU have done a lot of work on analysing the potential impact of it. It's not something we've done here at NFU Mutual in terms of numbers, because obviously the NFU are closer to that situation than us. So I can't really comment on that, to be honest.
That's fine. Thank you. Penultimate question, and I think this is we'll see. You may have an answer, but I don't think there's a necessary answer to this. But this is the nub of it. This is why we believe that poultry farms will be disproportionately impacted by these tax changes. So the question is, some of our farms are worth more than 10 million as poultry units, and we cannot split off parts and sheds to pay this tax. We need the land as range area. How will we cope with this tax burden in normal trading conditions when the returns for farming are so poor?
I think that's the crux of the NFU's case, really, in that, it does present huge dilemmas for is that you, Gary, or it does present huge dilemmas, really, for the farmer. It's going to have a potentially an enormous impact, and that's why so much work is going into lobbying on it to present the facts to the government. Exactly, illustrated in that case, really. It's quite interesting because obviously farming has quite rightly taken a lot of the headlines. The farming unions have been very, very active, but they can act as sort of one voice, if you like, in representing agricultural businesses to the government. I did a similar sort of seminar to this, really, with some business owners about 3 weeks ago, and a lot of them weren't aware, because it hasn't been in the media in the same way. But it's having a huge impact. There was a guy that I was chatting to who had a manufacturing business that's worth about £5 million, and he said, "Am I affected by this?" I said, "Well, yeah." Runs it with his two sons. I said, "Yes," because it's business, agricultural and business property relief. So I think there will be a growing voice as well from the business community, adding their voice to that of the farming unions, really, because of the impact it has, right across the economy, really.
Yeah. Thank you. Last question, Sean.
Okay.
I suppose it's more of a statement. This makes it even more imperative that farmers write a will. And this is an obvious one, but I would imagine there's still estates where there's no will. So this makes it even more imperative that a will is written. And part of that is succession planning with the next generation coming into that family farm business. It's critically important that they also plan. So this is a long-term planning sequence of through the generations in a way, isn't it?
Yeah, definitely. Yeah. So I mean, wills obviously very, very important. But I think, and what it will encourage people to do as well is look at their sort of family situation, partnership agreements. Those are traded as partnerships. It's really important to unpick basically who owns what's owned by the partnerships. What's owned by the partnership, what's owned by the individual members of that partnership. Just getting a clear picture to work out what the situation is. And yeah, obviously, wills are very, very important, as are things like power of attorneys. Power of attorney that become ill, have an accident, whatever. I mean, a lot of customers say to me, "Well, they're just for old people, aren't they?" And they're not just for old people; they are for all of us, particularly business owners.
Yeah. Very good. Thank you, Sean. Please come back in 6 months' time.
Happy to. Yeah. That'd be great.
Members, please take professional advice. Thank you all for your attendance on the webinar this evening and for the questions that have been posed. The recording will be made available. Sean covered an awful lot of ground there, rightly so, and I'm sure you'll want to go through the recording again. And as well, it'll be made available to members that weren't able to join the webinar this evening. So the recording will be made available in due course. I'll close the webinar by thanking you again, Sean. That was a really good session, really good insight. And as I say, we'll invite you back in due course to do another webinar. Thank you all again.
Okay. Thanks, Gary. Thanks, everyone.